So here are the strength of the market makers. So market makers can induce traders to take positions. So they give you the pattern you need for you to take a position, and after taking your position, then they will hit the stops. So they can also create fear, they can create panic to induce traders to become emotional and think irrationally. And this can be created by quick moves, like you see spike candles, especially during news release. And sometimes you see inexplicable price behavior, like there's a certain price behavior that you cannot explain. So that is only to create panic, to create fear, or to create a need for you to take an entry. They can also hit the stops, clear the board. They know who is in margin trouble, and they toy the spread. They are the ones that they give out the ask and bid prices. So depending on the market conditions, they can change the ask and bid prices. The restrictions that they have is that the IMF restricts their ability to move price to a general range. So basically they're limited to the average daily range. That's why we have the ADR incorporated in our template. Also, their capital is limited, like they do not have unlimited equity. So it is necessary for them to close their position and regain balance periodically. We basically have 3 sessions, namely Asian session, London session, and New York session. And this is according to my time zone, so AT GMT+3. So basically there are 3 market makers positioned strategically around the world, each in each time zone. So there's 1 market maker. So in order for the market maker to create a swing, they need to trap a certain amount of liquidity in a specific price range, and then you'll see the market swinging in another direction. So leaving that liquidity trapped. So they can they have specific times there they create these trap moves, mainly the beginning and end of the week. So Monday to Friday. So Monday and Friday. So week beginning, usually you see a false move, or Friday you see a false move. And we have the beginning of the day, even the end of the day. And we'll talk of the period setup there. We have the beginning and end of each session, simply because when a new session commands, it brings to them new targets. People are waking up in certain time zone, entering the market. Also, we have the beginning and end of the season. We're talking of the seasonal moves here. We usually have this trap move. So basically on our second quarter this year, we had a trap move around May. So last month we had, the market was very choppy. We had inexplicable price behaviors and all that. That's because on higher time frame, the market was having a trap move. So we'll go to the power of 3. And the power of 3, we'll be talking of the period setup. What happens in the 24 hours session? So basically the market has 3 phases. We have the accumulation phase, the profit release phase, and the distribution phase. In the accumulation phase, you find the market consolidating, and then you have what we call the Judas swing or the false move. And then after that, the dealer now has the liquidity to enter the profit release phase, where you see range expansion, profit is permitted. You need to be in the money when that occurs. And we'll end up in consolidation, where smart money will be distributing longs or shorts, where it's the distribution phase. So usually the accumulation occurs during the Asian range, and it sets the initial high and the initial low of the day. So usually the Asian box has the initial high and the initial low. So the Asian high and the Asian low. And then you see a stop and move against the real intention, which is the Judas swing, which is the false move, usually 25 to 50 pips from the Asian box. And then you see the real trend where it's the range expansion, profit is permitted, which moves 6 to 8 hours. Then the day would end off high or low back to consolidation. So basically you see a standard bar daily back candle like this, where this is the Asian open, this is the market close. So this was a downtrend. This is the Asian open, this is the market close. So this is an uptrend. So basically the market would consolidate. So you first see a consolidation, and then see a false move going up, and then a range expansion where you see 3 intraday levels, and then the dealer would end the day back to consolidation. The same for an uptrend. So before they will go up, you have a false move going down, a pattern will be formed, 3 intraday levels will be seen, and then the day will end up back to consolidation. So basically the wicks, and the body for the daily candle. Even here, the wicks, and the body. So we have some flashcards here to illustrate what we've just learned. This is the Asian session, basically where the market consolidates, and the Asian session high and the Asian session low would mark the initial high and the initial low of the day. And then you see a turtle soup raid. Usually it occurs, but sometimes it does not occur. And this now is the false move. And this false move goes to the previous important high or low, can be the previous day low, previous day New York low, or previous day high. So here is the importance of the support and resistance that we've learned. And the blue tracer indicator we have on our template would be seeing the importance here. And then this will be the pattern that we are waiting for. So it will be an optimal trade entry. And then you see 3 intraday levels to complete the average daily range. During New York session changeover, we'll have a trap move like that, and then we'll have an uptrend to complete the ADR. The same for sell setup. The market would have a false move to previous important high or low, and then you see the market forming a pattern, 3 intraday levels to complete the average daily range. So this was USD a very good consolidation, a range of 11 pips. And then we had a turtle soup raid, and this was a false move coming towards previous day low. And then you see a real move going up, and then the day did end up back to consolidation. So this is the period setup. 24 hours, the market moves like that. And here we had a downtrend, and this was a very good accumulation, a range of 15 pips, a turtle soup raid, and then a false move going up to previous day high. We had our entry there, and then the market moved 3 intraday levels, did end back to consolidation. So basically we are talking of the 15 minutes time frame when we talk of the pre setup or the power of 3. Now we have learned on the false move, the Judah swing or the stop point. So we need to go deep in how to identify the stop points. So stop hunting is a strategy that attempts to force some market participants out of their positions. And how do they do that? They drive the price of an asset, here we're talking of the currencies, to a level where many individuals have chosen to set their stop loss orders. So basically, to the market makers, stop hunting is a strategy to them. So generally, if they trigger the stop losses, it leads to high volatility, and there it can present an opportunity for investors who seek to trade in this environment. There is where we take our entries. So we usually trade after the stop point. We can also define a stop point as a sharp move to the high or low, and can be the high or low of the previous day, high or low of the previous week, month, or year. So the larger the time frame, the larger the stop point. So if it occurs that the market is doing stop hunting in a higher time frame, like in the daily time frame or the weekly time frame. For example, CAD during the month of May, it was around the previous year high. So it stayed there for at least 6 weeks, chopping around. So in lower time frame, it was hectic. Like the market is buying today, selling tomorrow, or buying today, selling today. So it was like that because the stop point was in previous yearly high. So the larger the time frame, the larger the stop point. So on the 15 minutes now, how do we identify the stop point on our daily basis? How do we identify the stop point? It's usually 3 swipes on the 15 minutes. And then this is the first swipe, second swipe, and the third swipe. Usually 25 to 50 pips. And then on the third swipe, if you go to the 1 minute chart, you get what we call 1 minute 3 inducements. So on the third move, you get 1 minute 3 inducements. So this is an example. This was gold. So we had the first swipe, the second swipe, and the third swipe. So it went all the way to the previous day high. On the previous day high, we had our pattern formed there, and then we had a downtrend. So on the third swipe, if you go to the 1 minute now, we see the 1 minute 3 inducements. So there is where you know that the stop point is completed. Personally, I usually only look on the 15 minutes time frame. Like if I see 3 swipes and it has reached maybe a previous day high, previous day low, or a previous day New York high, New York low, sometimes it does that. So I know that the stop point is now complete. So if we wait for the pattern in order to take a trade. So here we had, this was the first swipe, the second swipe, and this now was the third swipe with 3 vector candles. And here we had Euro news. We had consecutive news. So this was the first news, and then the second news. Now we had this uptrend going up. Now, when you go to the 1 minute chart and look on the 3 vector candles, you'd see this was the first inducement, the second, and the third 1 minute inducement. So basically 3 swipes, and on the third swipes, you'll see, on the third swipe, you see the 1 minute 3 inducement. So this was Euro pound. Also another example, we had the first swipe, the second swipe, and the third swipe. Right on that stop point box is where they apply the brakes. So around that area, when you go to the 1 minute chart, we saw that we had these 3 inducements, and then later on, the dealer formed a pattern, and we had this move. So the market was did not move during this New York session, but it came to move during Asia. So after the stop pointing, we usually wait for the pattern for us to take a trade. Now, what are these patterns that we usually wait for? We have the M's, the W, we have the 22 pattern, the 21 pattern. We have the V pattern, an A-top pattern. We also have low test and high test pattern. Now, the anatomy behind an M pattern. Why should we take an M pattern? What actually occurs when the dealer is forming an M pattern? So basically, we had very good consolidation here. This was USD chair, a small chart also prayed. So this was to induce buyers, the first swipe, the second swipe, and the third swipe. So basically, the dealer is inducing buyers. So this was a false move against their real intention. And then we had our first leg M. So we have those who are enter their buys and then put their stop losses just below this candle. So we call them weak buyers. So this will be stop point for weak buyers. but also it will be an entry for aggressive sellers. So there's those sellers who enter their orders here. So it's an entry for aggressive sellers. And then you would see our second leg forming, where the dealer will be using more buyers. If you draw a trend line here, you'll see that this is the third touch. So I saw one of the retail traders, he was drawing this on when the dealer was forming a W and they took a sell, and I knew that it was forming a W there. So that's where I saw that this whatever the market makers are doing is working. Like here, we have a trend line, and then this will be a third touch. So in using more buyers, sometimes this comes and breaks this first leg. So it will be also stop point for those weak sellers who have put their stop losses just nearby. And then after that, the dealer now has the liquidity to reverse the market. So we see our second leg M. So usually wait for these two EMAs to cross. The one with yellow and red, so the mustard and ketchup, the 5 and 13 crossover, and then a candle close below these EMAs. So usually below these two EMAs, but if the 50 EMA is near, you would wait for a candle close below the 50 EMA. There is where you take your entry. So this is the safest entry that you can take. Your stop loss above there, usually 23 to 30 pips. And there's the M. Now we have like a quick M here. So we had a very good stop and high. And then as the dealer was going down, we see there's a retracement here with the presence of a red candle. So that's an M like this, and then we had a downtrend. So if you go to lower time frame, like the 5 minutes time frame, you would see that this is a very good M. So in order for you to identify it better, you can go to lower time frame. Now a W formation is an exact opposite of an M. So the dealer will be using sellers. So this went all the way to the previous day low. And then our first leg now, it will be stop point for weak sellers, but also aggressive buyers would enter at this area. And then the dealer would induce more sellers. If you look at this candle, we had a very strong momentum, this red candle here, going down. So it was inducing more buyers, and then there is where we find our second leg W. So our 5 and 13 crossover, and then a candle close above the CMAs. So that's our entry. And then we had another entry here above the CMAs. And then we had a very good move going up. So here we had a quick W formation. Like we had a very good stop and flow. And then the dealer formed a W here. If you go to lower time frame, you would see a very good W formation, and then we had a very good uptrend. We have what we call the 22 pattern, the second leg of a second leg. So basically the dealer forms our first leg M, counts for the second leg M, doesn't give you the entry confirmation. And then from here now, he'll form another M. So basically this is the second leg of this second leg. So that's a 22 pattern. So our entry is the same, 5 and 13 crossover, candle close below. There is where we take our entry for sell. We also have 21 pattern, which is a multi-day pattern. The dealer forms a W on the previous day, and then on the next day we had a very good V. So this tap to the blue tracer, very good V formation, and then we had an uptrend there. You see, this pattern is usually very good, and it gives you 0 drawdown trade. So you get a very good V, and then that's a 21 pattern. So it's 2-1 pattern. The same for a downtrend here. We had an M this and then we had an 8 top here. So this was a 21 pattern. We also have an 8 top pattern, which is an opposite of this. So we had a very good stop and high, 3 swipes to the high, and then we had this reversal pattern there. So usually these candles coming in would give you engulfing candle like this. So I usually look for engulfing candle, or I look for an evening star pattern. So here we have a doji. So an evening star pattern like this, or engulfing candle for me to know that this is an 8 top. So in order for you to to know better of these V's and M's, like in order for you to be sure that the dealer will not come back for a second leg, you need to mark as many charts as possible on the entries. So you need to go in the previous charts, look at how the dealer was forming these M's, how the dealer was forming these W's, how the dealer was forming these A tops and V's. And if you can see it in hindsight, then it is clear for you that you can see it as it's happening. It is happening in the real time. So go back to the previous charts. That's the only way you can know. Like there is no, I think there is no rule. Like I can tell you that this will not come back to the second leg, but these patterns keeps reoccurring. So the same means and method that they used on the previous pattern, they would use it in the future. So we have the high test and low test patterns that occur around the blue tracer. Yesterday's high and yesterday's low. So the dealer would find the yesterday's high. This is yesterday's low. Give you a pin like that. And then you would have a candle close above it and a reversal pattern will be formed. I usually enter these patterns very aggressive, like you can see here. As soon as this candle was closed, I did get my entries there. And then we had this uptrend going up. So this pattern, this high test, this low test patterns. So we had this low test pattern here. A very good stop and flow was seen. A very good low test pattern. And the dealer formed an M, but I had an aggressive entry there. And then we had an uptrend. So here I had to wait for the M to form, and then the dealer moved. So this was a low test pattern, but it was a counter trend. So the trend was going down. We had a downtrend on this. So the peak was high and the dealer was going down. And here we had a low test pattern. So if this occurs, you can counter this trend. So you can take an entry for buy here, and your target should always be the mile, the EMA of the, now with the 200 period. So you can counter this trend by taking a trade here, and your target should be mile. And when it reaches mile, you should wait for a pattern to be formed for you to take an entry for sell, basically. So the most important aspect when trading M's and W formation is your entry. So you can and will start to get trades with zero drawdown if you keep practicing patience, let the price come to you. So there's no absolute need to get emotional when you're trading these M's and W's, because when the dealer is forming an M or when the dealer is forming a W is where the dealer will be setting the high of the day or the low of the day. So when you take your trade, you would have the best possible risk reward ratio because you'll be taking your trade as close to the high of the day as possible or as close to the low of the day as possible, having a very small stop loss and more potential for reward. So the patterns are similar in different time frames. So the same method that the same anatomy that we have learned on the 15 minutes patterns is the same that would occur even on the weekly time frame or the monthly time frame. So we expect when the dealer is forming high of the day or low of the day to spend time of at least 1 hour and 45 minutes. So a good M, a good W is formed by at least 7 15 minutes candle, because this would be like 7 15 minutes candle. So you'd find that a good M or a good W, it has like at least 7 15 minutes candle. So we have learned of the patterns, we have learned of the stop point, and now we also learned on the period setup that the dealer usually have a consolidation before the stop point, and that is the Asian box. Now we expect that most pairs to have an Asian range of less than 50 pips, because we expect during Asian range, during Asian time, during Asian session, the market makers will be consolidating the market. So any Asian range having greater pip range is said to be blown and not good to form a strong London pattern. So what are these London patterns? We have the type 1, the type 2, and the type 3 London pattern. So for the type 1 London pattern, is where you see the dealer breaking the initial high or the initial low of the day, having a very good stop point, forming a pattern for you. For type 2, the dealer will be maintaining the initial high and the initial low. So we'll be forming the pattern around the same, the Asian high or the Asian low. And for the type 3 London pattern, usually a straightaway trade, where you would see the 50 MA is around that area. So it'll be a 50-50 bounce trade also. The dealer will be forming a pattern around the Asian midline. So this is the type 3 London pattern, and on our template, previously we had the Asian midline situated there, so that you can easily identify the type 3 London pattern. But I came to remove it. I found it making some noise there, so I removed it, and the 50 MA usually is around that area. Now let us learn the most important part in our strategy, the market maker cycle. So basically, the market is based on a 3-level cycle. Market is based on a 3-level cycle. And before now, the market moves, the dealer would set what we call the peak formation high or the peak formation low. And then you would see the first level. After each level, you see there is a consolidation. So this is level 1 consolidation. And then the dealer would have a false move towards the peak, form a pattern. You'd see our second level, and then you see a consolidation, a false move, and then you see our third level. The same for a downtrend. You see our first level consolidation, usually a false move, second level consolidation, usually a false move, and then you'll see our third level. So some people call this a 3-day cycle, because they're counting the number of days that the market has moved. So this is day 1, day 2, day 3. So usually this level of consolidations have a 20 to 30 pips swings. Market makers will be hitting stops both ways to grab liquidity for the next level move. So level 1 is usually market maker driven, very fast. And you see level 2 is market driven in absence of market maker support. So it's driven by emotional traders. And then level 3 is market maker driven. You see the market maker's hand there, where the market maker will be triggering stops, creating panic, and then reverse the market. Levels are visible on all time frame, but we use the hour-1 time frame for the market maker cycle. So basically what we'll be learning here is on the hour-1 time frame. So this is gold. This was the peak. So the dealer set the peak. We had level 1 consolidation, level 2 consolidation, level 3. So level 1, market maker driven by emotional traders, market maker driven, and then eventually the dealer applied the brakes, reverse the market. So we have what we call liquidity delivery, that we expect the same number of pips that the dealer moves in level 1 will be the same for level 2, will be the same for level 3. So usually we expect that after 3 levels, 3 times ADR would be completed. So the dealer has moved 3 times ADR. And we usually draw the ADR boxes. So let's go to the charts. So this was pound USD. Now let me take euro yen. So we had the market reversing at this point. So we had a peak formation low. The dealer moves first level, second level, and the third level. Now, our ADR here is around 75, 79. So around 70, 70, 78 would draw. So I take the rectangle and then I plot it. So this was the lowest level that price has reached. And then I plot it. As I move, you find the number of pips there. That is 63.5. So 635 is 63.5. 628 is 62.8. So I'll be finding 78. So 77.8. So even that is okay. So that's ADR times 1. And then I hold control on my keyboard. I drag this using my mouse, so that would draw a second ADR box. And then we'll draw a third ADR box. So basically we expect if the cycle completes, we see 3 levels, and then we see that the 3 times ADR has been completed. So we know that now the cycle has been completed. Sometimes the levels are not clear. So the 3 times ADR boxes would help you to identify that the cycle is completed, like what we had here. So the levels were not clear, like this was a very small level, this was a second level, is a very long-term consolidation, waiting for the Forex news, and then they hit it with Forex news to complete the cycle. So here we had, this is USDR, a very good peak formation high, and then we had our first level completed 1 times ADR, our second level almost 2 times ADR, and our third level. But the 3 times ADR was not completed. So the dealer extended the price to complete the 3 times ADR, and there is where he applied the brakes. So having reached level 3, usually the dealer objective changes. See, in level 1 and level 2, he's simply pushing the market going down, or he's simply pushing the market going up. But having reached level 3, he will need to reverse the market. So he'll need for him to grab liquidity for that reversal. So you'll see pricing dropping or rising a bit further to demonstrate further bearish, further bullish movements, satisfying various criteria for retail traders. And after they enter in the wrong direction of the trend, that is where they will pull away quickly and move price away. So level 3 will appear disorganized. Price will be chopping back and forth, usually within a wide range. So you're seeing here from this example, this was level 3, where price is chopping. And then we see that is collecting liquidity down here. So we had this as a liquidity pool, and then the market reversed. So when traders lose money, they take a day off to reevaluate their decisions. So market makers know this and must chop the market to bring them back into the fray. Then the cycle continues. So I would expect for the market makers to chop around for more than 2 days. So I would expect for a good consolidation peak to occur more than 2 days. So if he applies the break today, I would expect for him to chop for the next day. And on the third day is where I would start to be looking for a pattern for me to take a buy. So this is level 3 behavior on the 15 minutes time frame. So this is where I applied the breaks on Thursday. And then we had a move going up. And then on Monday, week beginning, we had this false move. See, he did break these previous lows, grab liquidity, and then he reversed immediately. So a 4 days consolidation, and then he reversed. So after the cycle is complete on the hour 1 time frame, what should we expect? We should expect one of the following. The first and utmost thing we should expect is reversal, price reversing direction. The second is price extension, and usually you would see this when you're analyzing from higher time frame, like price has to reach there before reversing, although it will be beyond the market maker cycle move. And then the third thing we should expect is a peak reset, but a peak reset usually occurs after the reversal has occurred. So usually the market forms a reversal, moves 1.5 ADR, and then have what we call a peak resets. Now let's learn one by one. So reversal. When price reverse direction, what does it indicate? It indicates that the market makers have run a level of stops and a significant move should unfold in the new direction. So in order for you to know that price is reversing direction, you should look for a peak formation low, a peak formation high. We will learn on how to identify these peaks. And we should be looking for liquidity pools residing just above an old high or just below an old price low. So this is an example of a reversal. So we had a peak. We had like the first level, the second level. And if you look at it, this was the highs that he formed. And here he showed a very good downtrend. So creating a liquidity pool area here. And then he reached this area again, creating a downtrend. So right there, the dealer came, fetched liquidity, and then reversed immediately. And if you see, this reversal occurred after he went below this old low. So after he grabbed the liquidity that was below this old low. So the same here, we had the market forming equal lows, having this uptrend, but then he had a sharp move going down to grab liquidity, and then immediately it reversed to complete the cycle. So we had level 1, level 2, level 3. So when I see price reversing direction, I usually look if there is a liquidity pool, or even if there was an order block. So all those are internal range liquidity or external range liquidity. So any of the two should be there in order for me to see that price is reversing. So the second thing that we should expect is what we call the price extension. And price extension here, we see further bearish, further bullish movement the dealer makes after the cycle is complete before having a reversal. So the cycle is complete, and then you see further bearish, further bullish movement. Usually the dealer finds certain targets to satisfy various criteria for each trader or to grab liquidity for reversal. So sometimes he extends in order for him to find the liquidity for reversal. So what should we look for when we are analyzing the market in order to identify if at all there will be a price extension? So we should be looking for large quarter points. When you come to learn of the quarters, you would see how they work. We should be looking for support and resistance areas based on the weekly and monthly time frame. If it's near where the cycle is complete, maybe a few pips, 30, 50 pips, you would see the market would find those areas of supports in lower time frame, and then reversing the market from there. Also, we should be looking for exponential moving averages based on higher time frame. That is the daily, the weekly, the monthly. Now we have important moving averages that we will be looking for price to go and reverse around them. The 200 EMA, the 800 EMA. So here we have an example of a price extension. So we had a peak here, level 1, level 2, level 3. 3 times a year was off. So basically the cycle was complete, but then price extended to find the large quarter point, and there is where he reversed direction. And we see level 1, level 2, level 3. So here we had, this was the daily time frame for gold. So basically this was where price started moving, going up. At this level, we had equal highs, and then we had the 50 MA above it. So basically price extended to the 50 MA, but also it extended to grab the liquidity above, residing above it. So this was a liquidity pool area. After grabbing the liquidity, he immediately reversed direction. So the third thing that we should expect is what we call a peak reset. What is a peak reset? A peak reset is a peak formed as a continuation of the previous cycle. Suppose we had an uptrend. So we had level 1, level 2, level 3. And then we had a peak formation high. The dealer moved, but then it forms another peak, which is as a continuation of this previous cycle. And then you see 3 more levels going up. So this is what we call a peak reset. So usually this newly formed cycle, this recent from cycle, is not completed, and usually moves 1.5 ADR. So a peak reset can be easily anticipated and easily confirmed as a retracement on the daily time frame. So we'll be using the daily time frame and identify these peaks. So here we'll start learning on the daily structure. So let us we learned on retracements when we're learning on the fair value gaps, like when price returns inside the recent created range. When price retraces, it indicates the willingness on the part of market makers to reprice to levels not efficient traded for fair value. So usually retracements that are occurring on the daily time frame, you would find them covering these fair value gaps and then meeting certain EMAs, bouncing from those EMAs, forming what we call a peak reset on the hour 1 time frame. So what should we look for in price? We'll be looking for bounces around 13 EMA or 50 exponential moving average, or a large quarter price on the daily time frame after a good peak formation on the daily. We'll also be looking for fair value gaps or voids of liquidity. Also, these mitigation blocks and breaker blocks based on the daily or the hour 4 time frame. So if there are no peak resets, the market will be ranging around 3 times ADR for each pair. So this is EURUSD daily time frame. So on the daily time frame, we also have 3 levels. We also have peaks. And on the daily time frame, the dealer forms peaks, maybe as a consolidation or as an M or a W. So here we had a W, here we had an M, here we had a consolidation, here we had a consolidation. So this was a W formed as a peak. And then the dealer moves to level 1, level 2, level 3. We had a consolidation formed as a peak. Dealer moved to level 1, level 2, level 3. So this was all level 3 behavior. And then we had level 1, level 2, level 3. We had an M. So this was level 1 going level 2. So basically, 1 level on the daily indicates a complete cycle on the hour. So it's usually 3 days cycle on the hour. So after the first level, after the dealer forms a very good peak formation, after the first level, we would have this as a retracement. Usually it comes to the 13 EMA, our first retracement. So that will be our first peak reset on the hour one time frame. So the 13 EMA on the daily is the same as the 200 EMA on the hour one time frame. So usually on the hour one time frame, you see that price has formed a peak reset on the 200 EMA. And then you see our second level, and then price would retrace. Usually on the second retracement, the dealer has enough ground for stop hunt. So usually he finds the 50 EMA or a large quarter point like this. And usually this is a 3-level cycle. Sometimes it completes the 3 times ADR. And then you'd see your third level. And then this is a complete cycle on the hour one. And usually this cycle has what we call the price extensions. Usually, if you look at it, it's like 4 days move, 1, 2, 3, 4. So usually it has a price extension. And then from there now, the dealer will form a peak. So after 3 levels on the daily, you should expect for the hour and time frame to have a long time of consolidation. So basically here we had like 5 days, and then we had this move, level 1. Our first retracement came all the way to the 13 EMA, but also the 50 EMA was there. So this is a solid peak reset on the hour one. And then you see our second level. We have this as a bigger retracement, usually 3 levels on the hour one. And then our peak was formed on the hour one. And then we see our third level. So this was all level 3 behavior. But also here we had another peak reset going down. Although it was choppy, but it went all the way down. So when the dealer forms a peak, it's not necessary that he moves only 3, maybe he makes only 2 peak resets on the hour, 1, 2. Sometimes you would see 3 peak resets on the hour one, sometimes even 4 or 5, depending on where price has to reach on the higher time frame before reversing direction. So depending on the market structure. And then here now, we had level 1, level 2, level 3. So 3 complete cycles on the hour. So let us have a look on this last move, this one. How do we view it on the hour? So this is the hour time frame. We had this as our first cycle, our second cycle, and our third cycle. So those are the 3 levels that are on the daily time frame. If you look at it, the peak resets are formed around the 200 EMA. We had a peak formation low, level 1, level 2, level 3. Peak formation high, the market moved all the way to the 200 EMA. And then we had our peak reset. We had level 1, level 2, level 3. Peak formation high, the market moved all the way to the 200 EMA. And then you see level 1, level 2, level 3. And then here is where the dealer was forming that big M on the daily. So basically, that's how we anticipate, that's how we trade the peak resets. Yeah? Super easy as that. So this was also a USD CAD daily time frame. You can see these are the 3 cycles. You can see on the first cycle, the dealer used the news to complete the cycle. And then you had a peak, went all the way to the 200 EMA. So the 50 EMA on the hour one, on the daily time frame, the 50 EMA is the same as the blueberry, the 800 EMA on the hour one. So basically, when the price retraces, going back to the 50 EMA on the daily, it indicates that the dealer is forming a peak around the 800 EMA on the hour one time frame. So sometimes you would see people drawing charts like this. These are actually not levels. This is Elliott waves. So never confuse it with levels. Let us finish with the exponential moving averages, EMAs. Exponential moving average, when used in an appropriate way and control, they can give you a true reading of market direction, a reading of market momentum if the downtrend or an uptrend has to come to an end. It can also give you entry signal or entry confirmation. It can also give you exit signals. Also, they may be used as moving support and resistance points. So the specific exponential moving averages that we're using are the one with a period of 5, which is yellow in color, we call it mustard. Period of 13, which is red in color, we call it ketchup. 50, light blue, which we call it water. We have the 200 EMA, white in color, we call it mayo. The 800, which is dark blue, we call it blueberry. And we added up the 3200 EMA, which is medium violet red. So basically, we have what we call the moving average conversion. So that I think that I was talking on the peak reset. Here's the clarity. So going up in time frame, if you divide the period of the EMA by 4, you can simply know the position of a certain EMA on one time frame in relation to another. Like on the R4, the period, the EMA with a period of 50 is in the same position as the EMA with a period of 200 on the hour time frame, the EMA with a period of 800 on the 15 minutes time frame. So going to the daily, the same as 13 EMA. So this is an area where we'll find our peak reset. So depending on which time frame you are, you can simply see a peak reset on the 15 minutes on the 800, on the hour on the 200, on the R4 on the 50, and then would have a 13 EMA on the daily. So basically, that's how EMA conversion works. And it's very important to have this in your head. So here, if you go to the 15 minutes, will be the 3200. That's why we added the 3200 EMA. Okay, so uses now. Uses depends on time frames. Like in each time frame, EMAs are used very differently. So on the 15 minutes time frame, our entry confirmation after the pattern is formed is usually 5 and 13 crossover. And after the dealer has formed a peak, he moved to level 1, you would see 50 and 200 crossover. So 50 and 200 crossover indicates level 1 lock. So we should be expecting for level 2. And the 50 EMA now on the 15 minutes time frame, we use it to take what we call the ID 50 trades and 50-50 bounce trades. The 200 EMA is used to take safety trade and the 200 bounce trades. The 800 EMA is used to take what we call the blueberry trade. But also is an area where we would find our peak reset on the 15 minutes time frame. The 3200 EMA, we find EMA peaks around that. We'll come to learn on EMA peaks. So jumping to our time frame, how do we use the exponential moving average? After the dealer has formed the peak, move to level 1, you find 13 and 50 crossover. And then after the dealer has moved level 2, you find 250 crossover. So 13 and 50 crossover indicates level 1 lock. 50 and 200 crossover indicates level 2 lock. So we should be expecting for level 3. And the dealer, when it's in level 3, you will find the separation of the EMAs. Like the EMAs are fanned out. The 3 EMAs, the 50, 200, and 800. And we have a flashcard here. So here we had a very good peak formation high. Level 1 was complete, 13 and 50 crossover. Level 2 was complete, 50 and 200 crossover. Usually this crossover occurs when level 2 is almost completed. And then this was level 3. So we have the separation of the moving averages. So the 50, the 200, the 800. So the 200 EMA is where we find our peak resets on the R1. And the 800 EMA, we find what we call the EMA peak. So going to higher time frame. So from the daily, weekly, and the monthly. Moving averages with higher periods tend to be like horizontal, like they have a very gentle slope maybe, or sometimes they're like horizontal. Simply because they take they need to feed in as many candles in order for them to show that price has reversed direction. So you'd find these EMAs of period of 200, 800, and 300, 200 EMA acting as moving support and resistance points. So if you see price bouncing on these EMAs, it simply indicates reversal.
Okay.
So that's what will come to clarify more on the seasonal moves. So when you come to learn on the seasonal moves, we also come to look on EMAs on the daily time frame. So any question from what we had today?
No. Yes, it's a very nice strategy. Yes.
Okay, so I'll send you the recording as soon as it's converted. So for
Okay.
now,
Sorry. One question is when the 50 and the 13 crosses.
yes.
So, for example, you need to have also an impulsive move, no? Because sometimes we see the cross, but without the impulsive move. So, like
this,
there, for example, there Wednesday, for example,
this one.
in this flashcard, the Wednesday in the peak formation, you have the cross. Wednesday. No,
Wednesday,
no,
yeah.
but yes, this is the peak formation. But on the left, you also have a cross
Of 13 and 50.
Yes, Wednesday.
Wednesday is here. Oh, you're talking
yes,
of this
you have a cross there.
of 13 and 50. There is no crossover. Oh, it's this one.
Here.
Okay, usually the crossover occurs after this level is completed. Yeah, it's not occurring around this. You see, when the dealer reaches level 3 and has the consolidation, it would occur that these CMAs are close to each other. And it would occur that these CMAs might cross, but this crossover of level 1 lock usually occurs after the dealer has completed this level 1. Even this 50 and 200 crossover, it occurs maybe prices around this area. Doesn't occur around this. Okay.
Okay. Some the crosses are important. Okay. Continue.
Okay, so I personally use the ADR boxes more.
Okay.
Crosses than the crosses. I usually don't mind the crosses.
You don't use weekly range? No.
No.
Okay.
Okay, so thank you for listening. Have a great day. Maybe later on, I will check you if you can have a session, maybe.
Okay.
Okay, so I'll send you the recording soon.
Okay, thank you.
All right.